Hey, what's up guys? This is ZQ Chiu here. So today I will show you the exact trusty indicator that I use daily in all my charts, the MACD. That's right? So the MACD, when used right, will allow you to not just catch trend reversals the moment they start, but also predict breakouts before they happen. Right, so stick with me throughout this video, all right? And I will show you how to use this tool the pro way. So what is the MACD indicator? Right, the MACD indicator, or as what they call the moving average convergence divergence, is one of the most popular technical indicators, right, used by traders out there. This tool, right, this indicator helps traders to spot trends and momentum, combining both to identify the best buying and selling opportunities, right? So this makes it a powerful tool for anyone looking to trade, regardless of whatever vehicles, right? Like Forex, stocks, crypto, commodities, anything, right? This is the tool that you want to add in all your trading charts. The MACD indicator consists of three components: the MACD line, the signal line, and the histogram. Now, let's understand each of these components in detail. The first one, the MACD line. Okay, these are the standard values, right? The standard values, unless you set them differently, these are the standard values. The MACD line is calculated by subtracting the 26 period exponential moving average, the 26 EMA, from the 12 EMA. These are the standard settings, 12, 26, 9. So now, here's an easier way to think about it. So imagine, right, you're looking at two moving averages, right? Two moving averages, right? One for the short term, 12 days. One for the long term, 26 days, right? If the short-term average, the 12-day EMA, is higher than the long-term average, the 26 days EMA, it means that prices have been rising recently, right? So now, when you subtract the long-term from the short-term, you will get a positive number, which is your MACD line, which shows an upward momentum. So now, if the opposite happened, the 12-day EMA is lower, it shows a downwards momentum, right? And the MACD line will be negative. So in short, the MACD line is just the difference between these two averages, telling you how the recent price movement compare to the longer term. Take a look at this example. It's pretty straightforward, isn't it? So now, next, we have the signal line, right? The signal line is a 9-period exponential moving average, the 9 EMA of the MACD line. It's as simple as it sounds. To get the signal line, all you got to do is to take the historical values of the MACD line and apply 9-period EMA. So what this means is that you're looking at the average of the last 9 periods of the MACD line, right? So therefore giving you more weight to the recent data. Let's simplify this, right? So now, if you see this data over here, imagine you got an MACD line with these values, right? 1, 2, 3, 4, 5, 6, 7, 8, 9. Step 1, add them up. 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7 plus 8 plus 9. And you got the whole table over here. So now, next. Step key, divided by 9. So divided all of them by 9 since we are taking the 9-day EMA, right? So therefore, you get the results. So in this example, the signal line is 5. I mean, you don't have to really know all this formula. In fact, I barely even know most of the formulas out there. I don't need to do. It's just that for this video purposes, like, okay, I do some legwork, right? But honestly, in today's world and a long time ago, your trading charting software has already done all this for you, right? The idea is to let you know how does this work, right? So the signal line is simply a smoother version of the MACD line that helps you to see trend change clearly. So when the MACD line crosses above the signal line, it's typically a buy signal. And when it crosses below, it's often seen as a sell signal. All right, like I said, typical, right? Typical. Now, next, the MACD histogram. The MACD histogram, right, it calculates the distance between the MACD line and the signal line. To get the MACD histogram, we only need to subtract the signal line from the MACD line. So the result is is a difference, right? It's a visual difference, right, between these two lines. Right, so here's how it works. If the MACD line is above the signal line, the histogram will show positive bars above the zero line, right? Which means what? The momentum increases. If the MACD line is below the signal line, the histogram will show negative bars, which is below the zero line, indicating decreasing momentum. For example, if the MACD line is 6 and the signal line is 4, then the MACD histogram is 6 minus 4, right, equals to 2, creating what? Upwards, right? Positive upwards momentum, right? On the other hand, if the MACD line is 3 and the signal line is 5, right, then MACD histogram will be 3 minus 5, which is negative 2, therefore creating a negative downwards momentum. So this histogram is to remove all this calculation. The moment once you see it above being green means what? The momentum is strengthening. If it's below it's red, it means what? It's weakening. So this is to allow you to understand that, alright, behind all these pictures, right, there are actually numbers and how it works behind it. But now how as traders that we can use is how we use the usage of it. So therefore, the MACD is actually a combination of all this representation that is made into all these bars and lines and everything. It makes it a very powerful tool to spot changes in market momentum. So now, here's the thing. Sometimes people will say, hey, Ezekiel, what is the best MACD settings? I mean, there is really no one size fits all or the best approach for MACD, because the market is constantly evolving. A lot of traders, they try to find the perfect MACD settings, believing that there's a best formula out there, I'm missing something, that kind of thing. The truth is what may work well today may not work well tomorrow, right? So the key is understanding how the MACD works, the core concept. When you understand the relation between the short-term and the long-term EMAs, you can apply the MACD to suit your trading strategy, right? Whether you are day trading, swing trading, or say you are investing for the long term. The flexibility of the MACD allows you to adjust based on the time frames that you are trading and the market conditions, right? So rather than trying to find a perfect setting, focus on using the MACD to spot momentum shift, the strength of the trend, and potential reversals. This deeper understanding will allow you to use it and adapt it to the market conditions as they change. That's where you will give you an edge over traders who just rely solely on some of the indicator settings, that kind of stuff. Now, the three main components of the MACD: the MACD line, the signal line, and the histogram. Alright, so now let's see and let's understand how to use these components in different market conditions. First one, the histogram slope. The histogram slope, or the shape of the histogram, gives you a deeper understanding of the trend. So the distance between the MACD line and the signal line increases when the trend is in a strong trend. So now, as a result, the histogram expands. An expanding histogram is signs of a growing momentum. So therefore, if the histogram is expanding, we should look for entries in the direction of the trend. As the trend gets weak, the histogram will start to shrink. This indicates that what? Right, the momentum is lost, and price might reverse, or stay sideways. So then, it's probably better to exit your trades and wait for price to generate momentum again during this kind of period for a better visual representation. The MACD histogram has light and dark colors. We see dark colors when the histogram is expanding, and then the light colors when it's shrinking. Okay? And that's a good visual representation, isn't it? Right? So at the beginning of an up move, you will see 2 or more dark green bars with an expanding histogram, right? It gets bigger. This is a sign that the upward momentum is growing, right? It's solid, it's growing. Therefore, it's good to look for buying opportunities because now the momentum is moving in that direction. We are not using the MACD as of this an entry signal alone, but this is good as a basis on top of however you are trading. Using the histogram itself, as of now, is a good confirmation of the momentum in the market. Okay? So now, when the histogram starts to fall or decrease in size, depending on your trading system, it tells you that the momentum is slowing down. The market cannot be constantly going up. The market will slow down, will go sideways before going up, will retrace a little bit before going back up again. But this tells you that the momentum is slowing. When it's slowing, the momentum decrease, right? A reversal or a sideways trend may now establish itself. As you can see, the shrinking of the histogram coincides with this sideways range. Then we have this downwards move. At the beginning of the down move, you will see these dark red bars with an expanding histogram. Again, depending on your trading strategy, this is your chance to exit your previous buy positions before. Now, the dark red bars signify what? That new sellers have entered the market, right? And they are moving the market with heavy momentum, strong momentum. It is also potentially time to enter new short positions. So now, once price move a certain distance, the histogram will start to shrink. And in this case, it is the previous low. And that's where you start to see it shrinking with the light red bars. So this is an early indication that the down move is losing momentum and a reversal or sideways range may start to establish. Price stays sideways as the histogram shrinks. This is one use of the MACD, right? It's just one use. You cannot base your, again, that's why I'm saying again, you cannot base your trading decision on just this one factor alone. I'm going to show you how to combine it with other elements, right, in advanced strategies. But before that, understand the usage of it. Let's move on to the second use, crossover. Many traders like to use the moving average crossover system for trading. But crossover happens only after a good move in price, not in a sideways market. As a result, when there's a good move, your entries would need to be on time, as price has already moved a lot. In order for us to address this crossover problem in a way, we can use the MACD crossover. The MACD crossover gives you an early sign of a market reversal, right? It can also provide you with better entries and smaller stop loss. I'm going to show you this. I'm going to plot a 12 and a 26 EMA along with the MACD on the chart, which is also 12 and 26. The MACD is calculated based on the 12 and 26 EMA, right? So this should be a fair comparison, isn't it? Now, here is the reversal area, right? So from this point, price reversed from an uptrend to a downtrend. The crossover for the moving average occurred here. So your entry would be on this candle. But as you can see, price has already moved for quite some distance before the crossover signal. So ideally, your stop loss would be like kind of this high, right? Which is a wide stop loss. Now, if you look at the MACD, your entry signal would be earlier on this candle as the MACD line crossed below the signal line. So this gives you what? A far better entry price with a tighter stop loss. So with this, you can capture a bigger RR, a bigger risk to reward ratio of the whole movement instead. Let me give you an example. On this candle, the 12 EMA crosses above the 26 EMA. This is a bullish crossover. So what? A buy signal occurs here if you are entering based on the moving average crossover system. However, the crossover only happens after price moves a certain distance, isn't it? Because there's this period. Now, on the other hand, the MACD crossover occurred right here, giving you a far better entry price. I mean, as a result, your RR is going to be a whole lot more compared to you entering later on the chart itself, isn't it? Right? So MACD crossover can be an early sign of reversal. But they generate also a whole lot more false signal. So you cannot just use this crossover as like a standalone. A more confirmed signal is the zero line crossover. Okay, here it goes. Usage number 3, the zero line crossover. The MACD consists of what? The zero line, which is the midpoint of the indicator. So when the 12 EMA crosses below the 26 EMA, right, the MACD moves below the zero line. This shows that the trend and the momentum have shifted downwards. A downward trend may start. When the 12 EMA crosses above the 26 EMA, right, the MACD moves above the zero line. Right, this shows that what the trend and the momentum has shifted upwards. So therefore, price may start an uptrend now. So the zero line crossover will give you fewer false signals. But then again, we need to add more confirmation for them to be high probability trades. Usage number 4, the zero line pullback. In strong trending markets, the MACD line will often pull back. You know, not just a chart pullback. The MACD line also pulls back to the zero line, and price will bounce back. So now, in an uptrend, the MACD line pulls back to the zero line. This makes it a good place to make entry, right? Buy entry at the retracement, at the pullback of the zero line. Okay, but again, we don't just want to randomly buy whenever the MACD line reaches the zero line. You want to wait for the MACD line to cross above the signal line to make the buy trade. Now, moving on to the last usage. All right, you're learning something? Yeah, good. Usage number 5, divergence. Okay, divergence are signs of reversal, signs of weakness in the market. And this is very helpful in spotting trend changes as well. Divergence occurs when the price and MACD gives you different outputs. This is where you can use histogram to spot the divergence. Divergence have 2 types: bullish divergence, bearish divergence. So the bullish divergence occurs when price makes a lower low, but the MACD makes a higher low. This shows that the momentum in this lower low move is lesser than what you think it actually is. Okay, the momentum is not as strong as what you think it actually is. It's a sign that the sellers are tired, right? And price will likely stall, go sideways, or reverse upwards. Here's an example. Price is in a downtrend, right? It's in a downtrend. Then the price created 3 lower lows, each lower than the previous one. However, the MACD makes what? Higher lows. So the MACD is giving you a contradicting signal. This is what we call divergence. It shows that what? The sellers are losing their strength and a reversal may occur, making it a good buy signal. So now, on the other hand, bearish divergence. Bearish divergence occurs when price makes a higher high, but the MACD makes a lower high. Right? It shows that the momentum in the last move was lesser than the prior move. This is a sign that the buyers are tired, and the market will likely stall or reverse. In this example, the price is in an uptrend, right? It's in an uptrend initially. The market makes higher high, but on the MACD, you see lower highs. This is what? A clear bearish divergence. So this is a sign that the buyers are losing momentum. They cannot push up anymore, right? They're losing the momentum, they're losing the strength, right? As a result, the sellers might jump in to lower the price. So now, let's talk about two common mistakes that traders make when using the MACD indicator. They are trading the MACD crossover and misinterpreting the MACD histogram. Right, first off, trading the MACD crossover. The MACD crossover strategy, it performs well in strong trending markets with clear upwards or downwards momentum. However, this is different when a market is in a range-bound market, sideways, choppy sideways market. In sideways or choppy conditions, the MACD, right, can generate a lot of false signals. So since price constantly got to crisscross, right, oscillate within the tight range, the MACD is going to what? It's going to keep crisscrossing, right, above and below the signal line. So resulting in a ton of false signals. There are better ways to use the MACD crossover. So next, number 2, misinterpreting the MACD histogram. Sometimes when you see the MACD histogram, you see strong green bars expanding, you'll be thinking like, there's strong momentum now. It's time to buy. It is a solid point, but in trending markets, a clear MACD crossover might signal the end of a trend, right? The end of a trend, making it too late to enter. So the market could be overextended and prime for a reversal rather than continuing in the same direction, even though the histogram is showing you a strong momentum. So a better approach in such situation is to go against the momentum and look for reversal opportunities. So this strategy involves what? Involves you in watching for signs that the trend is losing steam. The trend is losing steam. Can't go up anymore. It's kind of going sideways, losing steam a little bit. A lot of traders, when they first start trading, the common mistake is to chase for breakouts, for example. Right? Whenever they see a strong bullish candle, they feel like, it's going to break out. You have to buy the breakout, right? Thinking that you're going to catch the trend. But instead, you realize that, hey, if you keep doing that, it's going to work. One potential issue is that they are also entering a little bit too late. By the time they buy, the price is at the peak and ready to reverse in the opposite direction. So here's the thing, contrary thinking. What if you go against the crowd and instead of buying, you short? What if you short when you see a strong bullish momentum? Things are going to change, right? Shorting during a strong bullish momentum could actually work better than chasing it. Right, cool. So now let's sum it up, right? The MACD is a trend following and momentum indicator that helps you to spot potential buy or sell signals, right? You don't want to blindly trade the MACD crossover, although it is powerful, but use it as a trend filter to improve your winning trade. Okay, the MACD histogram predicts the momentum shifts and market reversal. So look for strong moves into key market structures, followed by a price rejection. Pullbacks at the zero line are very powerful areas of entry as well when it crosses back up, isn't it? When the MACD histogram is flat, it signals that the market is consolidating and could be ready for an explosive breakout, right? Don't adjust your MACD settings, like going to try this and that. There's no one size fit all. You understand the theory behind it. The 12-26-9 setting works. So for higher probability setups, use the MACD in combination. Look, there's no one indicator like once you see a crossover, I'm in, that kind of thing. You got to combine them. You got to combine them to increase the probability. So this allows you to understand the whole structure of the market and how trading works in the overall perspective. When you start to add the MACD into your trading system, this will make it an extremely powerful tool. And that's the reason why I use MACD in all my charts itself. Good? So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.